bulls are back in control, and this is exactly why market analysis matters. I started this week with a neutral tone on Sunday, and now, just a few days later, that tone has shifted. Not because of opinions, not because of feelings, but because the market changed. If you want to survive and stay profitable, you have to be willing to pivot when the data pivots. And right now, the data is favoring the bulls. Before we get into individual setups, let's zoom out for a quick market overview, because this rotation is the real story. One of the reasons I leaned neutral to slightly bearish coming into the week was because we were seeing rotation out of risk-on areas like tech and especially the Magnificent Seven. Meanwhile, financials, the second heaviest sector in the market, along with healthcare, were quietly carrying the tape higher. That's not a bad thing, but it's not the type of leadership that typically fuels strong momentum moves. This week, that changed. We've now seen rotation back into tech and quick crypto pump, while healthcare continues to run. That shift has injected fresh momentum into the market. Financials are taking a breather, and that's fine. If financials catch another leg higher while tech stays strong, this market could really accelerate. The risk only shows up if tech rolls over again while financials continue to lag. For now, though, with SPY printing another all-time high, it's very hard to maintain anything other than a bullish bias. Let's start with SPY. Today we tagged another new all-time high, but it didn't come without a fight. The rejection off the highs tells us the next opportunity is likely going to come from a higher low rather than straight continuation. The most important level I'm watching is 689, which was the prior all-time high. Holding above that level keeps SPY in a very strong bullish location. If we see a pullback towards 686 and then a sharp reversal back up through 689, that's a clear signal that the bulls are on parade and this market continues higher. One thing worth noting is that this new all-time high is only marginally higher than the previous one. As the highs and lows compress, we are building a rising wedge. Rising wedges are typically bearish patterns, but they are not guaranteed. This is not a prediction. It's simply something to be aware of. If we were to lose 686 with follow-through, that could open the door for short-term put opportunities down towards 680, where we have the last major higher low and the 50-day moving average. That said, there is currently no indication that this move is on deck this week without a major catalyst. Until proven otherwise, pullbacks are still buy-the-dip opportunities. Now, let's talk about QQQ, because this is where things get interesting. On the tech side, we did make a new higher high on the trend count, but it was aggressively rejected, forming an inverted hammer on the daily chart. Even more important, price briefly broke out of the symmetrical triangle pattern but closed right back at the level. That tells us this is still a decision zone. This inverted hammer candle is going to tell us a lot. This type of candle at the top of an up move is specifically called a shooting star, which is bearish. To play the shooting star setup, you want to see a clean break under yesterday's low of 622.56. If momentum is strong entering, puts using the 622 or 621 QQQ puts for this Friday would be how I do it. If it's hesitant around the low, you also could be patient, look for a break, and then a pullback up into 623 for a rejection, and that would be a very strong signal to enter. Everything is about risk reward, so if you get in this, manage your own stop loss, but the technical way to play this is to set the stop loss at the top of the wick from the shooting star and set the target price at the bottom of the most recent low. Because that recent low has a longer wick, I am going to set my final target for 613. If I take this trade, I have to be cautious of 618.50. So if I take 10 contracts, I may trim up to 7 at 618.50. That is a critical support level, and the 5, 20, and 50-day moving averages are stacked there. It's worth holding some runners if it breaks through. On the upside, the move higher was rejected right at the double bottom neckline I discussed in Sunday's video. That level is 625.80, and it is extremely important. If we get another push up to 625.80 and can hold above it, that sets up a long play back toward all-time highs. I really like this structure, and for QQQ, 625.80 is absolutely on high watch. Next up is Apple. From Sunday's video, the head and shoulders pattern I highlighted around 266 has now confirmed. We broke cleanly below that level on Tuesday and followed through today by pushing under 260.85. Structurally, this keeps a bearish slant on Apple. That said, if tech continues to strengthen, we have to respect the possibility of a counter-trend rally. If Apple can reclaim 260.85, show support, and then push back toward the head and shoulders neckline at 206.6, that sets up a very clean plan. In that scenario, Calls could make sense first for the relief bounce, followed by puts again on a rejection of 266. Those puts would target a move back to 260.85 and potentially continuation lower toward 251 or even 245, which aligns with the expected move from the pattern. Right now, I am not interested in pressing shorts or puts unless Apple puts in a new lower high. I think a relief bounce comes first, and the key is letting the structure confirm before getting aggressive. Finally, let's talk about Google. This one is clean. The pattern here is an inverse head and shoulders, and the neckline sits right at 322. We pushed above that level today, but closed right on it, which is very common behavior around key breakout zones. If we get a clean break above 322 followed by any kind of pullback that holds as support, call options toward 327.50 are absolutely in play. If price reaches 327.50, there is a lot of open air above, with the next major target sitting near 333, which was the overnight high leading into the last all-time high. On Google, I'm not interested in a downside play at all. This is a level-to-level long setup, and 322 is the only thing that matters. So stepping back, the takeaway is simple. The market has shifted back into a bullish posture, driven by rotation into tech and risk-on assets. SPY is holding above prior highs. QQQ is coiling for a larger move. Apple is setting up for a tactical bounce within a broader bearish structure, and Google is flirting with a clean bullish breakout. As always, stay patient, stay disciplined, and let the levels do the talking. If you found value in this update, make sure to like the video, subscribe, and turn on notifications so you don't miss the next market shift when it happens.